What's up, guys? It's Rob here, and we have to talk about support.com stock, which is actually seeing a green day today. Ticker symbol SPRT. Let's take a look at the chart. We have it right here, and you can see that overnight we rallied up. We're up about 6% on the day, and we are actually trading near this $26 support level, which we actually did just break through. We'll see if that sustains itself. Hopefully not. Right? Hopefully this thing goes back above 26, which has identified itself as a support level, right? On the big day when this stock hit 59.69, we ended up crashing down, and by the end of the day, we were trading around 26, which we bounced off of, identifying this as a support level, and yesterday we actually broke through, but today we have kind of rebounded, and although we are kind of dipping below it right now, it's not guaranteed that we're going to stay below it. We could potentially be breaking above it once again. So with SPRT, there are a couple of things to pay attention to, because I've been doing a lot of research on this stock lately, and there's some very interesting things that I've come up with regarding the potential short squeeze that we could be experiencing pretty soon, and some of the difficulties that we might experience regarding that as well. So the first thing to note with SPRT is that the percent of float shorted is 61.93%, which is actually incredibly high, and that has a lot of people's hopes up, right? That's the statistic that a lot of people are pointing to regarding the short squeeze, hoping that, institutions are going to have to start closing their short positions, and that this could actually shoot up the stock price by quite a bit, especially if Robinhood traders or even wallstreetbets traders are pushing this up even more, right? The higher this gets, the more likely these institutions are to have to close their position, and the higher that it will shoot up when they do. What's important to note, though, however, is that the market cap of this stock is only 760 million. And that actually, has its pros and cons, right? You can look at a stock like, let's look at AMC, for example. You can see AMC has a market cap of 22 billion, right? This is after their big run up. Now, SPRT's market cap of 760 million. This means this stock could more than 25x and still not even be close to AMC's market cap. So that would be a very impressive gain for this stock, especially considering the fact that, over the past 90 days, it's already 10x'd, right? We were down at 232. Now we're up at $25. So if this 25x, that would be a 250x increase from this original stock price right here. So that would be very impressive for SPRT to do, and it would have a lot of investors sitting very far in the green. That would be great for a lot of these retail traders who are trying to short squeeze the institutions out. However, the downside of this market cap being 760 million means that it's going to be a bit harder for institutions to actually need to buy back their shares. And what I mean by that is the way that short selling works. Let me explain this really briefly, just so you guys understand. The way that short selling works is, say, an institution wants to enter a short position. They would, and say the price was $10. Say they did this a while ago. They would sell a share of this stock and receive $10 in cash in exchange for that. And then they would have the option later on, they'd be hoping that the price of the stock would drop down maybe to $6, and then they could buy back that share and give it back to whoever they borrowed it from. And then they would only have paid $6 for it, so they would have a $4 profit. A lot of the time, if we look at the chart, you see the price of the stock shoot up, and they end up closing for a higher price. They end up having to buy back the share at a more expensive price, let's say $60, right? Now, the situation that actually causes them to close their position is there are two potential situations in which they close their position. One, they get scared because the price is rising very quickly, and they don't want to have to buy back at an even higher price. And they might decide to close their position, say maybe they closed it at 20, right? Because they're worried that it'll go to 60. Another situation is they don't have an option to keep this open, right? They have to close it because they're getting margin called by their brokerage. And the brokerage is essentially, watching this and saying, hey, you borrowed this stock when it was $10 and you only have $10 to show for it. Now the stock's worth 60. You don't have enough money in your account to justify having that much debt, right? If you took a large position on it. Now, what a lot of brokerages have potentially done, right, is they were probably shorting this long ago in the past when this stock had not yet 10x. Maybe 90 days ago, they were shorting this thing when the market cap was only 76 million. So even though the percent of float shorted is rather high, they were potentially only shorting that with very small positions, right? If the market cap was 76 million, even if 100% of the float had been shorted, that was only $76 million dollars worth of short positions, right? And if that's split between 10 institutions, that's about 7.6 million each. Now, these aren't, exact numbers. These are just theoretical. But let's say that was the case. Now this is 10x, so those are $76 million short positions, even if the float was the percent to float shorter was 100%. So what that would mean is that this stock would actually have to rise quite a bit because institutions have a lot more than 76 million on their balance sheet. Oftentimes institutions have billions of dollars, and this would actually have to rise quite a bit before they get margin called, most likely by their brokerages. So that is a potential downside to this particular short squeeze, right? We would actually have to rise this. I mean, we got all the way up to 59.69, and although we didn't close the day that high, that obviously wasn't quite enough to cause a short squeeze. We'd have to get even higher than that before these institutions start getting margin called on their accounts and having to close these positions, or potentially, they could keep these positions open and close other positions. So that's a real danger with this stock, right? Because the market cap is so low and was so low before this began, a lot of the short positions that institutions have might still not be at very high dollar amounts. I mean, high dollar amounts for us, right? Millions of dollars is a lot for us, but for institutions, they do have a lot of cash. They have a lot of other assets that they can use as collateral against the debt that they're going to be holding. And, with a stock like this, which is, I will admit, mostly a meme stock, mostly an attempt at a short squeeze, it's going to be tough to get institutions to want to close their short positions out for very inflated prices, right? They might be more willing to sell some other things and just kind of hold these short positions at massive losses if they can, unless they actually get margin called. They might be more willing to close out some other investments and just have more cash on hand so that they can maintain these positions until the price goes back down, because they do expect, I believe, that the price will go back down. If you look at the yearly chart, I mean, it's mostly a short squeeze that has caused this. And, if people lose interest and the price goes back down, there's no real fundamental reason to keep this company at such an inflated price. So institutions are likely aware of that and will probably be trying to wait as long as possible before actually closing out their short positions, which, has its pros and cons. It could backfire on them. And they could end up, holding a lot longer, and this stock could just keep going up and up and up, especially if more retail traders get involved and just start holding as many shares of the stock as they can. That could really burn the institutions in the long run. So it's a high risk, high reward strategy that they'll most likely be using. However, it does mean that we'll have to be a little bit more patient with this short squeeze, and that there is a bit more urgency also. Like, we will not, the faster we can get this thing moving up, the more likely it will be that we can actually scare some of these institutions into closing their positions, right? If we get this thing shooting up, 100% every couple of days, then that would really scare some institutions, and they'd say, hey, it's looking very likely that we're going to have to close our short positions. We may as well do it now. And that would cause the price to go up even more and end up maybe making some other institutions get margin called or scare them. And that's a real situation that we could be facing. And that would be very beneficial for a lot of retail traders. So that's what I have for you guys today on SPRTsupport.com. Thank you guys for watching. If you've enjoyed this video, feel free to subscribe, like the video. No pressure to do it if you don't want to, but if you would like to, I would greatly appreciate it. And I'll see you guys in the next one. Have a great day. Bye.